Welcome to Classic Value Investors and Microcap Explosions. I just listened to the 15th annual International Shipping Forum, and the full video from that forum is available in the description below. In this video, what I'm doing is I'm taking some of the highlights and I'm making a video out of it. But if you want to listen to the whole video, the link is in the description below. Tomorrow, I will do a video on highlights from the same forum about the product tanker, but this video is about the crude tanker. As you probably saw, things are happening in the oil tanker market, and for those of us who are paying attention, it could become very advantageous. So let's get on with it.
We are in this industry because we like the volatility, we embrace the volatility, and we are exposed to the spot market because we like that volatility. So you have different type of owners, and some owners prefer to have fixed contract, and we believe that overall the rewards are less attractive than when you are on the spot market. And if we take that decision, obviously, we have to be prepared for that volatility. What does that mean? Well, it simply means that you have to have a strong balance sheet, you have to have a decent liquidity position, because admittedly today, we're not making even break even on our ships. So we have had absolutely fantastic earnings last year. We took part of that in reserve. We distribute quite a lot of the rest to our shareholders via dividends and share buyback. But obviously all of that still means that we continue to have a strong balance sheet. And then the second thing that I wanted to highlight, it is true that we are in dire territories, but let's not forget that we've all been around for a certain amount of time in this market. And we like also the volatility or the cyclicality, because that enables us to grow our platform at the low point in the cycle. So if we didn't have that cyclicality, you wouldn't have the opportunities to grow the platform, and that I think is a very important aspect, as much for the ship owners as it is for the investors, because if they want to make a good return, they better come in and join in at the bottom of the cycle and not wait for the rates to go skyrocket, like you mentioned, 300,000. At that time, the share price is probably at a very high level and not so attractive anymore.
The nature of the business drives the cyclicality, I think, not necessarily how we behave. And I think the biggest change in the driver of cyclicality is going to be the leverage. There's not as much leverage available. There's not as much capital available. Institutionally, there's less interest in the industry. So my view is, as the leverage comes down, the volatility should come down if economics follow, normal economic behavior. But as far as our lessons, we're all chasing that volatility. The people on the screen here are in this business for a reason. They're in this business because they like the volatility and they think they can optimize it and take advantage of it. So, the extreme nature of it does hurt sometimes, but that's why we're all here.
Look back just a little over a year ago, beginning of 2020, before we really knew because we couldn't know what COVID was going to do. We were looking at a pretty good market. We were looking at an upcycle for probably a couple of years, at least, maybe more, 3 years, which would then inevitably been followed by a down cycle. And, so we were looking at harvesting cash for a while. And instead, we got a short, brutal, volatile COVID cycle, right? But this is, as the others were saying, just part of the business. Volatility, has come to shipping in so many different ways. This was unique or new, but so we got a new upcycle. We took advantage of it, all of us on the panel, to build up liquidity, delever, return cash to shareholders, be prepared for, most importantly, and this goes to your question, be prepared for the down cycle that inevitably follows. So here we are, less levered, a lot of liquidity, ready for cash flow slight drains, and equally poised for the two opportunities that a down cycle gives us. There's the gift of the thing. We weren't expecting the opportunity of a down cycle in 2021. It was going to be 2 or 3 more years. So now we still have the opportunity that we didn't expect to potentially allocate capital to assets if they're looking attractive, and we have good balance sheets to do it. And for those of us that are still trading at a really good, really steep enough discount to our NAV, we equally have the opportunity to create value per share by buying our shares. So with enough liquidity, you can pursue both, and that's our plan.
This pandemic has kind of took us all by surprise. As Jeff said, we were all expecting the super cycle to come, our way, sooner than reality produced. All the dynamics were and still are in our favor. Historical low order book, demand was at historical highs pre-COVID. We had the IMO regulations that were accelerating the scrapping of all the tonnage, so the supply was reducing, was expected to reduce even more. So everything was shaping up for us to have this super cycle. Unfortunately, things unfolded differently, and that created this gap, if you like, that we expect to make up in the future. We're all dancing on the tune of the vaccine and the rollout of the vaccine and how quickly the vaccine, will change not only the health part, if you like, of the equation, but also the sentiment, which will eventually translate into people traveling again and those missed barrels coming back into the market. As I was talking to an investor earlier, he asked me, where do you think, what stage are you guys in, or the industry? I said, well, we feel like, the runners, the speed, the sprint runners before the 100-meter final in the Olympics, we're all in our lanes doing the little warm-ups, the little jumps, and waiting to position ourselves and to hear the gunshot. And I think, we could have, the usual customary false starts, but eventually the sprinters will start running. And I think we are there. We're in the stadium.
Well, I think that everybody's waiting indeed for the vaccine campaign to be successful. I think different countries will take a different pulse on that. Some of them are more advanced than others, but some of them are prepared to relax the measures a little bit earlier than before reaching the famous 70% herd immunity or whatever it's called. So basically, we believe that the measures will be relaxed by the summer. And then it's going to be a little bit gradual for the people to return to some form of normality, and it's going to be probably a new definition of what we call normal. From that aspect, we expect a strong recovery in the oil demand. Indeed, people are going to start traveling, and this is true for business and true for tourism. I think that after a period of so many restrictions imposed on people, we may even contemplate sort of an explosion in the other direction, where people really want to do what they have not been able to do, and then we will arrive to some form of normality. And then the second catalyst is obviously how many ships are going to be scrapped in the meantime, because as many other people said in this panel, when the market is in such depression, the very positive thing is that people cannot afford to maintain very old ships and return them after a very expensive survey into a loss-making market. So we've seen about 11 ships being scrapped this year, if we take into account the 6 ships that were announced by COSCO, and we are only at the beginning of March. So in the first 2 months, 11 ships. I mean, if you were to extrapolate that, we would be at 60 ships. That would be a dream scenario. If by the end of the year we had 60 ships recycle, I think that we are on for a fantastic market, which would start next winter or next year. But we don't work in calendar years in this market.
And to get that 100 million barrel a day level, I think is going to take the airplanes in the sky, and they're on the ground and they're waiting to move. So I'm very, very optimistic about what's going to happen just a little bit later in this year.
Yeah, so I want to sort of tie that into the discussion of share buybacks versus purchases of assets. So Hugo, you guys have been active. What's your take on buying back stock? Are you buying back stock, and what are the opportunities on the asset side relative to your stock?
Yeah, this is something that we have expanded in recent years. I mean, certainly last year we spent a lot of capital on share buyback, 118 million. We have earmarked another 50 million for this year. and that was at the time when we announced Q4, and truly the share price was 20% lower than it is today. So today we have sort of closed the gap on NAV, or we're very close to our NAV, and we are at a point where it may not be required to do share buyback. I think when we compare share buyback to asset purchase, if the share price is at or around NAV, we will always prefer to buy assets. And certainly when we are still in sort of low territories for values. As I said in my first intervention in this panel, the cyclicality of the market provides good opportunities at the bottom of the market, and we are at the bottom today. Values went up since the beginning of the year already. That's on the back of hopes that the market can recover quickly, but also steel price going up, new building price going up. So it's all those things together that you have to take into consideration when you want to take a decision on whether you do share buyback or whether you buy additional vessels. And as you know, we prefer to buy second-hand or resale of contract than adding to the world fleet, because that's always an additional ship that is coming into the fleet. So that's a little bit how we think about it. Many movable parts, and you cannot really set a policy on it. You really need to see all of those things together and then take a decision.